Hey folks, how's it going? Not sure how many of you know about this by now, but the Silicon Valley Bank was closed by regulators and FDIC has taken control of it. The stock for the Silicon Valley Bank started dropping on Thursday. It's dropped more than 50% on Friday. I don't remember exactly how much it dropped on Thursday, but on Friday it dropped almost around 50%. So regulators and the FDIC has taken control of it and shut it down. Silicon Valley Bank, just to put that in perspective, before I go into the article here, it's if I'm not mistaken, the 18th largest bank in the United States. This shutdown is the second largest bank shutdown in U.S. history. It is the largest shutdown since 2008. That's according to the articles that I've read so far. But the FDIC has said it's taking control of the bank via a new entity it created called the Deposit Insurance National Bank of Santa Clara. All of the bank's deposits have been transferred to the new bank. Insured depositors will have access to their funds by Monday morning, the FDIC said. Depositors with funds exceeding insurance caps will get receivership certificates for their uninsured balances. Now, going on in the article, once a darling of the banking business, SVB collapsed at warp speed after it announced a big loss on its bond holdings and plans to shore up its balance sheet, tanking its stock and sparking widespread customer withdrawals. So there was a bank run. You haven't really heard about bank runs since the Great Depression. Well, here you go. This is the first that I've heard of a bank run. Is this going to be the first of many to come? Who's to say? I would say it probably leads to some serious doubts about the banking system, the banking industry. Back to the article though. SVB Bank collapsed at warp speed after it announced a big loss on its bond holdings and plans to shore up its balance sheet, tanking its stock and sparking widespread customer withdrawals. The bank is the 16th largest in the U.S. with some $209 billion in assets as of December 31st, according to the Federal Reserve. It is by far the biggest bank to fail since the near collapse of the financial system in 2008, second only to the crisis-era shutdown of Washington Mutual Incorporated. The bank's parent company, SVB Financial Group, was racing to find a buyer after scrapping a planned $2.25 billion share sale Friday morning. Regulators weren't willing to wait. The California Department of Financial Protection and Innovation closed the bank Friday within hours and put it under the control of the FDIC. SVB, based in Santa Clara, California, earlier this week surprised investors by announcing it had lost nearly $2 billion selling assets following a larger than expected decline in deposits. The stock has lost more than 80% since then, and tech clients rushed to pull their deposits over concerns about the bank's health. This is a really long article. This is like 7 pages long. I'm probably not going to read the whole thing. But there are some things in here that you need to know. The bank's troubles have dragged down the entire industry. The 4 largest U.S. banks lost some $52 billion in market value on Thursday, and a broader index of bank stocks had its worst day in nearly 3 years. Bank stocks continued to plunge Friday morning with a number halted for volatility. Bankers at Goldman Sachs Group Incorporated had arranged for SVB to sell shares at $95 apiece on Thursday afternoon, according to people familiar with the offering. As the stock kept tumbling and more customers pulled their deposits from the bank, that deal fell apart. The share sale was canceled Friday morning. On Friday morning, bank told employees to work from home today and until further notice, according to a copy of the email viewed by the Wall Street Journal. SVB catered mainly to startups and to investors that fund them. an insular ecosystem that has taken a big hit since the Fed began raising rates last year to curb inflation. Rising interest rates, meanwhile, dented the value of SVB's bond holdings. The bank late Wednesday disclosed it had sold a big chunk of those holdings at a loss. Investors dumped the stock, spooking customers and sparking a bank run. Chief Executive Greg Becker had a call with jittery customers Thursday telling them the bank was on solid financial footing despite the loss. But concerned SVB clients were already calling rival banks looking to move large balances in excess of FDIC insurance caps. All right, so it goes on talking about different investors' calls and things that were said, but basically things that SVB were imploding as of Thursday night. Let me scan down through here a little bit more. All right, so SVB's deposits boomed alongside tech industry, raising 86% in 2021 to $189 billion and peaking at $198 billion a quarter later. The bank poured large amounts of deposits into U.S. Treasuries and other government-sponsored debt securities. Soon after, the Fed began raising rates, and rising rates in the tech downturn caused deposits to decline, spurring the bank to sell substantially all of its available-for-sale securities at a major loss. There's a lot more going on to this than what's being said. Insured depositors are being told that their accounts are being insured up to $250,000 a piece. Anything over that is not insured. There are some people that don't have insured accounts with that bank. They're not being guaranteed anything. And I'm going to put this to you pretty simply. I don't have the numbers off the top of my head right now because I didn't take the time to do a search. I'll be honest with you. I've got a lot of other things going on today. But the FDIC can only bail out or insure one or two major banks in the United States at a time. They don't have the funds to cover massive bank runs at multiple banks all at one time. That being said, if there is a bank run on one bank and it cascades or snowballs into a run on multiple other banks, they're not going to be able to cover everybody's deposits, which means that any money you have in your bank may or may not be available to you and may or may not even be insured. And just understand that just because it is insured by the FDIC doesn't mean you'll be able to get your money out right then. The majority of a bank's business comes from loaning out money and investing money. So everybody thinks that when you deposit your money in your bank account, the bank's just sitting there with all this money piled up in the vault, just sitting there, and it's not. Because when you deposit your money in a bank, you're basically giving your money to the bank. The money then, technically, by law, becomes the bank's property. It's no longer your money, it's the bank's money. And in order for them to make a profit, they loan it out to other people and they invest it. So when a lot of customers come to the bank and try to draw out the money, they don't have everybody's money there that they can hand back out. That's what causes banks to shut down. And in the most simple terms, that's what causes a bank to shut down when there's a run. They don't have everybody's deposits on hand at all the time, because that money's been loaned out to other customers, it's been loaned out to companies, it's been loaned out or invested in different kind of treasuries and assets. So the minute you put your money in the bank, it's no longer your money, it's the bank's money, and they spread it out in a whole bunch of different areas. So that when you go to your bank, they're relying on basically somebody else depositing money in order to give you what you what's yours, what you're wanting to get out. That's why when everybody goes to the bank at one time, the bank can't cover everybody. And the FDIC works along similar principles. They have enough funds to cover one, maybe two bank failures at a time. If you have multiple banks failing at one time, the FDIC cannot cover everybody's deposit to the insured $250,000 amount. So what they'll end up doing is they may be saying, well, for the next week you can only get $25 or $100 out. And it may, if you've got $15,000 in the bank, you might only be able to get $50 to $100. And you may have to wait until some date down the road before they can give you any more. And even then, you won't be able to get all your money back, because they just can't, they don't have the funds to cover it, folks. Here's the problem. I've been talking about this kind of stuff for a while, and I've been talking about how you don't need to have all your money in the bank. The FDIC cannot insure it. Banks are over leveraged. They haven't learned anything from the financial crisis. They've done the exact same thing that they've been doing all along. What caused the banking crash back then, they're still doing the same things. They're investing money in bad assets, bad decisions, bad financial decisions by the banks. That puts your money in jeopardy. Even the elites that are in charge of the global banking system understand how fragile the banking system is, particularly here in the US. And I've heard discussions, videotaped and audio recorded discussions during these meetings by banking in the industry, where they were talking about how the public has far more confidence in the banks than they do themselves, and they're the ones that own and operate these banks. That should scare the crap out of you. So, is this an isolated incident? I don't know. I would say that this is a symptom of a much larger issue, and this could foretell or be a signal of things to come. This is a large bank, and if this one has fallen and has placed strain on other banks, that's going to create ripples that affect all the other banks in the United States. And not just the United States, worldwide. You need to understand that banking systems are global. They're interlinked all across the world. So take this as a warning shot. This bank failed, and I guarantee you that excuse me, folks, I guarantee you that every other bank in the United States is doing making a lot of the same financial decisions, managing money in a lot of the same ways, and they're just as fragile. The only thing is that they might be able to hold on a little bit longer, or they might be able to shuffle things around enough to avoid a collapse right this minute. But I would say that this is a sign that there could be, and in my mind, there will be more bank failures. This is probably not going to be the last. It's probably just the first of many. So, as I've said in the past, don't keep all your money in the bank. Keep the lowest amount of money in the bank you need to pay your bills. Any excess, keep in your home where you have easy access to it, because even if you've got plenty of money, you've got thousands of dollars in the bank, and you're not behind on any bills, your job's not in jeopardy, whatever, what have you, if that bank goes under, you may not be able to get your money out. There have been instances where a bank went under and people were only allowed to get $20, $30, $40 at a time out, even though their bank account balance showed thousands of dollars available. Once you give your money to a bank, by law, that money is owned by the bank and they can do with it as they please. And just because your account shows $10,000, $15,000, $5,000, whatever, doesn't mean all of that money is actually sitting in the bank right now. Because every transaction is simply a data entry showing where money is being moved around. The physical money is floating around in the world, being used to loan other people money, pay bills, invest in assets, loan to companies. That money is not sitting in the bank. If you think about it, let's just say, make the assumption that every bank's customer has no less than $500 in the bank. Each of those customers that have $500, that $500 is not sitting in that vault. You need to understand that. That's the problem with the fractional reserve currency system that we have right now, banking system. I'm not going to get into explaining the fractional reserve system. You can look it up. You can research it on your own. I think you need to. If you're not familiar with it, you really need to. Basically, all I'm going to say about it is it essentially says that for every $100 that's deposited into a bank, the bank turns around and takes anywhere from $90 to $99 of that $100 and turns around and loans it out to other people or invests it. And they hold on to that $1 or $10. The vast majority of the money that you deposit into that bank gets put elsewhere and is no longer in their hands. So, don't keep any more money in your bank account than is absolutely necessary to pay your bills. Any excess that you have or any excess that you want to hang on to for liquidity, keep it home, locked up in a safe, keep in a secure location. Invest in gold, invest in silver if you can, if you believe in that kind of thing. Invest in food. Build your food stockpiles. Build your systems of support for when utilities go out or are not available. Build medical supplies. Build tool supplies. Things like that. That's where you need to be putting your money, in all of those places. Always keep some on hand in cash, locked up. At home, you don't want all of your money in the bank because you want to be able to get to some money to buy food, buy gas, what have you, if this kind of thing happens again. And believe me, this is probably not the last time you're going to hear this. This is probably the first in a series of dominoes that's going to go down. I could be wrong, but I wouldn't bet on it. And as I've always said, it's better to be safe than sorry. Taking these precautions only benefits your security, your safety. So, just wanted to make you guys aware of that. Appreciate you guys watching. Like, share, subscribe if you haven't. And until next time, folks, take care. I'll catch you later.